My name's Jon Vass from Tradeshift, and I'm here to talk to you today about a 5-year plan for finance. So we're really talking about how fintech is going to be evolving over the next 5 years, and also digital reality for businesses. So as I'm sure you're aware, we live in exponential times. And as Moore's law starts to reach critical mass, what we're experiencing is a shift in technology. So Moore's law is where every 2 years, the amount of transistors you can get for the same price doubles. And a really, really good example of this is a presentation which you can find on YouTube I did a couple of years ago, where I had in my hand an iPhone 7. And today I've got an iPhone 10, which is about twice as powerful as the iPhone 7, but the price point was exactly the same. And a real tipping point was in 1995. Large companies spent more than $15 billion on mainframe computers. But 5 years later, the PC replaced most functions solved by the mainframe, in addition to a huge amount of investment over the last 30 years, contributing hugely. And then a real telling sign is, over the last 5 years, the amount of funding that's gone into AI. So maybe, even at this rate, we'll have the Terminator in 2029. And on top of that, we've got the explosion of consumerism in the BRIC countries. So organizations are looking to innovate faster, to bring smarter products to the consumer world. And this is an example here from a Chinese shopping festival, where over the course of the festival, $17 billion was spent. And if you compare that to Black Friday and Cyber Monday, that's only $8 billion. So it's no surprise to hear that in the last 15 years, 52% of the Fortune 500 companies have disappeared. They've not been able to keep up with this tech revolution. So in 1955, the life expectancy of a Fortune 500 company was 75 years, but then in 2016, that fell to 15 years, and that's still falling. So there's no longer any guarantees of being big, and it's no longer an advantage to be big. So if you think about the largest companies in the world, they don't own any assets. So organizations like Facebook, Airbnb, and Uber. So then if we look into the horizon and look to see, there's 3 areas of acceleration in the financial world. So the first of those is digital collaboration. We're going to see a lot more digital collaboration, and that makes complete sense because more than 2 billion pieces of paper are exchanged every year in the modern supply chain. So this area of acceleration is long overdue. However, digital collaboration is something we're doing very, very well in our personal lives. Stand away from that. So Facebook, for example, and LinkedIn and Instagram, we use networks almost by default in our personal lives when we want to communicate with somebody. That's because you can easily find somebody on a network because we're all on it, and then it's just a connection request and we're live. But in the business world, this has been left behind. So in a lot of cases, we're still communicating one-to-one. So that's almost like your scenario when you've got the 2 tree houses and the piece of string with the 2 cups on the end. That's how a lot of businesses are still communicating today. And this trend in the consumer world, in terms of software and software price, is also now bleeding into the business world. So SaaS is the norm now in terms of pricing models, and transactional prices are heading towards zero, so EDI networks, for example. And if I ask you a question, how much money did you spend on software for your phone? So yeah, exactly. I spent zero. So the shift is moving away from the transaction and towards the network. And this is happening out there in the world. So if we look at these organizations, Airbnb is the world's largest accommodation provider, yet it's got no real estate. Uber's the largest taxi company in the world. They don't have any cars. And Alibaba is the world's most valuable retailer, yet they don't have any inventory. It's not looking very good, is it? So this has been an evolution over the past 25 years. So what that was supposed to be was that one-to-one connection that you saw earlier on. So that was how we were operating in the 90s in the EDI fashion. In the noughties, we started to see web portals bringing buyers and suppliers together. And then around 2014, we saw the introduction of the first true network platform, or B2B network platforms. So this is all well and good, but what does it mean for you guys here in the room? So what it means is the value coming from the CFO's office can double. So if we take AP automation as an example, the key drivers around AP automation are to lower operational costs, increase control and visibility, and faster invoice cycle time. So we're looking to save money. And that is if you can get your supply chain to participate in the program in the first place. But if you're operating on a true network, you could just roll out other functionality to that network. So for example, supply chain financing and dynamic discounting, turning all that onboarding effort just from a cost saving into a revenue generating exercise. And then if you have a true network, that's somewhere where your bank is going to want to be. So banks place themselves at the center of commerce, i.e. on high streets. They also place themselves on B2B networks. So what this does is increases the cash flow for everybody in the supply chain. And then as a byproduct of this, we've got lots of data points, or billions of data points. So we've got things like transactional data, supplier data, buyer, and product data. And we can leverage AI to do things like automatic coding because all the information's there, or get us information and present information in a way that humans can't, or at least can't do that very, very easily, because we all know that better data equals better decisions. So the second area of acceleration that we're going to see over the next 5 years is around trust and marketplaces. So if we go back to our China example, the core values, or traditional core values of trade, are trust, mutual accountability, dependability, respect, and obligation. And these things were exposed with Alibaba. So that's contributing to one of the reasons why they were so successful. But in February 2011, Alibaba experienced identity fraud, and their valuation decreased by $1.2 billion overnight. So that really proves the effect that trust has. And as a result, there are $9 trillion in trade assets on supplier balance sheets as receivables globally, but only 10 to 20% of outstanding receivables are intermediated by banks and other financial institutions. So the big question behind this is why? Well, because financiers don't know which SMEs to trust. There's no way of them knowing. And that was supposed to be a map of the world in the background. But one of the main contributing reasons to this is at least 5 billion people live in countries that are equal to or below Tunisia in the corruption index. So trust and transparency and trust in transactions is really, really important. And even in developed economies, that still applies when trading across borders. So in the big picture, reputation-based trust is the only model that works at a global scale. And the problem is, with a traditional transaction, is we don't have all that historic data that goes with it. So for example, if we've got a buyer in the West sending an order to a manufacturing site in China, that manufacturing site will send an invoice to the buyer in the West. And the buyer will generally take that invoice, and then they'll go and produce a remittance advice and then send that back to the manufacturer. But the best way of doing it, or the ideal way of doing it, would be actually to take that data, that invoice data, and flip it into a remittance advice, and then you would have all of that historical data going back or being recorded somewhere. And then what you could do is share this data on a ledger, on a shared ledger. And what this will mean is you can share it safely and access it via selected apps. So Location would be a very, very simple example of just one of these things. But if you're combining things like order information, shipping data, payment data, then you could plug in AI and trust score an SME. And in addition to this, there are new compliance schemes I'm sure you know about on the horizon, which means that you're probably going to need to record data like this and share it anyway, or you risk potentially not being able to trade with the rest of the world. So we're going to see trust and transparency being featuring even more over the next few years. So the final point on this topic is buying. So buying is changing. If you think about the way your employees will buy in their personal lives, online or e-commerce is the default, and they want to make sure they're getting the best product at the best price. They'll also look for peer recommendations on the product or the service that they're trying to acquire. A lot of the workforce are now millennials, and this figure's only going up, so they're demanding the latest systems and technology. There are around 200 million more mobile internet users than desktop users in the world, so people are no longer chained to their desktops. And there's a big shift to marketplaces like Amazon. So here's another question or a statement. Yet company buying hasn't changed in the last 20 years. So are you going to let Amazon own your future supply relationships? Or will you take control of the future of your supply chain marketplace, because purchasing as we know it is going extinct? So what you could do is create a private marketplace where you bring your suppliers, where there's trust and transparency, no middleman, where you can involve your bank, who can provide finance to your SMEs, and that increases liquidity in the supply chain. Okay. And then the final area of acceleration we're going to see, and we've touched on it already, is liquid digital assets. So we've already established that almost every interaction between trade parties is subject to questions about trust and transparency, which leads on to a hot topic, which is blockchain. And as most of us know, blockchain is a way of being able to share this type of data we've been talking about at close to zero cost. And this has been an evolution over time. So initially, you had a buyer and supplier sharing information via paper. Then we've moved to a network-based model, so it's digitalized and the data's in a format we can actually use. And then with blockchain, we're introducing additional parties such as financiers and auditors. But the big question that's being asked, and I still keep getting asked, is, well, what am I actually going to use blockchain for? And companies who have a reason to adopt or participate in blockchain will participate in many different blockchains. And there's supposed to be a picture there of a desert with a castle in the middle, but it's not. So we believe in volume first. So you don't build a blockchain castle in the desert. In fact, one of the most compelling use cases for blockchain is multi-party transactions. So multi-party transactions is when you may weave a bank or a credit reference agency or a fintech into the transaction between the buyer and the supplier. And in order to do this, you need to share those data points. So blockchain is a very compelling use case for doing that. And then if you add in your auditor as well, you have the opportunity to share that data with them. Transactions can be pre-audited before they're recorded, so then you have a true end-to-end touchless process. So transactions are dissolving. The shift is moving away from, or the value is moving away from the transaction to the network, and capturing information such as reputation information around identity, intercompany transactions and collaboration, shared product information, data certificates, workflow events, and third-party verifications. And then with this data, that can be then shared, so the sellers then can trade based upon a verifiable reputation not just the lowest price, and their history is going to give them access to markets and finance that they previously didn't have access to. So that's going to increase the supply chain liquidity and the cash flow for everybody. Okay, so I promised it would be a short amount of presenting. So I'd now like to open up the floor to discuss and collaborate any questions or thoughts and comments around those three topics. Yep.
So for digital collaboration, clearly it's important for third parties to participate. Maybe what are some of the incentives or strategies that can be used to get buyers, banks involved in these sorts of initiatives?
So I think the main thing is that, the main statement there is build it and they'll come. So if you have a network such as, to use an example from our personal lives, Facebook, for example, everybody's on Facebook, so it's where you can go and find someone. Therefore, it interests people who want to advertise on it, interests all sorts of parties because you're accessing people on a network. So the answer to that is, if you have the same thing but for businesses, you already have a critical mass there. You already have the network of buyers and suppliers there. They don't need to go and find them, persuade them to join anything. So if you then build your branch, if you like, your digital branch on there, it's a place where transactions are taking place. That information is being shared. So the banks are very, very keen to do that. So the best way of doing it is to be part of one of the big networks. Okay, so go ahead.
Actually, one of the around trusted marketplaces, you talked about Amazon and whether you go onto Amazon Marketplace or whether you go down your own road. Mm-hmm. What are some of the things that you would take into account before making that decision? Whether to go it out on your own and maybe take that risk, or whether to go a safer route and to go to Amazon? So
Amazon is an example of a network that exists, but it's something you can't control. So you need to decide whether you want to own your own supplier relationships or you want to let Amazon own those. Because that's what they're doing. There's nothing wrong with that, but it's this case of your strategic decision within your company, what you want to do. If you're happy for Amazon to own those and control those, then okay, no problem. If you're not happy with that, then what your own private marketplace does is just give you a lot more control within your organisation in terms of how you manage those suppliers, the prices that you might negotiate with them, how you bring them on board, how you deal with them, the information you gather from them, and all those types of things. So it's down to individual companies. And in my experience, most organisations tend to want more control than less. But if you're an SME, then maybe it'd be easier just to pull it from Amazon.
Sometimes it can come down to what's the investment involved in setting up that marketplace yourself in the first place, and actually how you drive the volume and footfall.
Yeah.
That can be the challenge.
Exactly. So when we say build your own, we don't mean build your own from scratch necessarily. There are networks out there that you can leverage. Okay, but then it gives you the full control over your supply base based upon that. Okay, thank you.